Long-term energy contracts are quietly reallocating risk. Long-term energy contracts were supposed to reduce volatility. For much of the past decade, corporate power purchase agreements, PPAs, long-tenor gas supply contracts, and fixed-price electricity arrangements were framed as risk mitigation tools. Lock in price, stabilize cost, improve forecast certainty. But in 2026, volatility hasn't disappeared, it has moved. And in many cases, it has moved on to corporate balance sheets. For CFOs overseeing energy-intensive operations, the question is no longer whether long-term contracts reduce price exposure. It is whether they are reallocating different forms of risk, basis risk, duration risk, counterparty risk, and policy risk, in ways that were underappreciated when the deals were signed. The assumption: fixed price equals reduced risk. The logic behind long-term contracts is straightforward. Hedge against commodity price spikes, provide budgeting stability, support decarbonization commitments, lock in supply during constrained markets. During the low-rate, high-liquidity environment of 2020 and 2021, these contracts also aligned with capital markets' expectations. Boards favored predictability. Investors rewarded structured risk management. But the market conditions under which many long-term energy contracts were signed are no longer the conditions in which they operate. Volatility has changed. Energy markets today are defined less by absolute price spikes and more by structural dislocations, persistent grid congestion in key markets, widening basis differentials between generation and load nodes, interconnection delays affecting project delivery timelines, rapid load growth in certain regions, demand softening in others. Policy incentives subject to evolving guidance. In this environment, a fixed-price contract does not eliminate volatility, it converts it. Instead of exposure to commodity price swings, companies may face basis risk if contracted generation does not align geographically with consumption, curtailment risk in congested markets, load mismatch risk if operational demand shifts relative to contracted volumes, counterparty exposure if project economics deteriorate. These risks do not show up in headline power prices, they show up in performance variance. Duration risk is emerging. Many corporate energy agreements extend 10 to 20 years. That duration was once seen as strategic alignment. It now intersects with a more uncertain demand landscape. Industrial electrification, on-site generation, storage adoption, operational footprint shifts, and regional policy changes can all alter future load profiles. When demand assumptions change but contract volumes do not, companies are left managing excess contracted capacity, market resale exposure, hedge ineffectiveness under accounting rules, cash flow timing mismatches. Long-term certainty can become long-term rigidity. From a finance perspective, that is duration risk. Risk is being reallocated, not removed. Energy contracts redistribute exposure among parties. Developers transfer price certainty to buyers. Buyers transfer revenue certainty to developers. Lenders evaluate which side bears long-term volatility. What has shifted is not the existence of risk, but its concentration. In several markets, basis spreads have widened materially relative to expectations embedded in early cycle PPAs. In others, congestion has increased curtailment probability. These dynamics do not invalidate contracts, they alter their financial profile. For CFOs, the key issue is whether these exposures are being monitored with the same rigor as interest rate hedges or currency swaps, because economically, they function similarly. Accounting does not neutralize exposure. Long-term energy contracts often qualify for hedge accounting treatment that can smooth reported volatility. It does not eliminate underlying economic risk. If physical delivery, nodal pricing, or load volumes diverge from modeled assumptions, earnings variability can emerge, sometimes gradually, sometimes abruptly. Boards may still categorize these contracts as fixed cost. Finance teams increasingly recognize they are structured risk instruments. That distinction matters. The capital implications long-term energy contracts can affect: EBITDA predictability, covenant headroom, credit perception in refinancing cycles, asset valuation assumptions, strategic flexibility in M&A or divestiture scenarios. In a refinancing environment where lenders are scrutinizing durability of cash flows more closely, embedded contract exposure becomes credit relevant. An energy hedge that introduces basis volatility may be treated differently than one that simply stabilizes commodity cost. This is particularly relevant for emissions intensive companies already navigating heightened underwriting scrutiny. The CFO question for 2026. The relevant question is not whether long term energy contracts were prudent when signed. It is whether their embedded risk profile reflects today's market conditions. Finance leaders should be asking, are basis exposures quantified and stress tested? Are load forecasts aligned with contracted volumes? How would widening congestion spreads affect earnings? Are counterparties financially resilient under market stress? How do these contracts interact with refinancing discussions? Long-term contracts remain strategic tools. In a market defined by structural volatility rather than price spikes alone, risk has not disappeared. It has been redistributed. The companies that understand where it now resides will manage capital more effectively. The ones that assume it was eliminated may discover the difference in their next earnings variance or in their next term sheet. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.